I know exactly what you're doing. I see you. You just bought another tube of Silver Eagles. Maybe you tucked away a nice little quarter-ounce gold bar that cost you way too much over spot. You're looking at the inflation headlines. You're watching the national debt clock spin past $35 trillion like a slot machine broke loose, and you feel safe. You feel hedged. You think you've outsmarted the system. My name is Alex, and I spend an unhealthy amount of time analyzing macroeconomic shifts so you don't have to wake up realizing your retirement account has the purchasing power of a damp sponge in 10 years. If you're someone who is stacking gold and silver because you know the dollar is doomed, but you feel like you're constantly missing the asset that actually delivers life-changing returns, make sure to hit that subscribe button. Look, I love gold. I own gold. Gold is monetary insurance. It's the brakes on your portfolio. But right now, the precious metals community is suffering from a massive collective blind spot. While everyone is obsessed with whether gold breaks $2,500 or if silver finally takes out $30, something is happening in the platinum market that defies basic economics. We are staring down the barrel of a perfect storm that happens maybe twice in a century. An unprecedented, irreversible supply collapse crashing head first into a violent upward shift in industrial demand. If you are holding only gold and silver right now, you aren't fully hedged. You are asleep at the wheel. Platinum is about to wake everyone up, and it's going to be violent. Before we get to the math, we have to understand why this opportunity exists. It's psychological. Platinum has a severe image problem. Gold is the king. It's ancient money. It feels regal. Silver is the people's money. It's volatile, exciting, the stuff of pirate legends. Platinum? Platinum is industrial. It's blue collar. It wears coveralls to work. Your brain and the YouTube algorithm is wired to think of precious metals solely as currency insurance. So you ignore the guy in the coveralls doing the actual work that keeps the modern world running. Investors prefer comfortable narratives over uncomfortable math. The comfortable narrative is gold protects wealth when the Fed prints money. It's easy to understand. The uncomfortable reality is that the gold trade is incredibly crowded right now. When everyone is on one side of the boat, you don't want to be the last guy jumping on. You want to be looking at what the crowd is ignoring. Let's look at the math that most people don't realize is completely broken. This is the gold-platinum ratio. Simply put, how many ounces of gold does it take to buy an ounce of platinum? Historically, for decades, platinum was more expensive than gold. Why? It's 30 times rarer in the Earth's crust. It's harder to mine. It has higher melting points. It is objectively more precious. Go back to 2008. An ounce of platinum cost over $2,200. Gold was sitting around $900. You needed roughly 2.5 ounces of gold just to buy 1 ounce of platinum. That was normal. Today, the ratio has flipped entirely. An ounce of platinum is roughly half the price of an ounce of gold. This is a historical aberration. It's a rubber band stretched so far it's about to snap back and take someone's eye out. It makes absolutely no sense unless you believe platinum is useless forever. Here is the simplest investment thesis in the world: mean reversion. If gold just stays where it is and the ratio merely goes back to its long-term historical average, where platinum is slightly more expensive than gold, platinum needs to triple from today's prices. Buying gold right now instead of platinum is like buying a stock at its all-time high, while its main competitor, which has better fundamentals, is trading for pennies on the dollar. But the price ratio is just the appetizer. The ratio tells you it's cheap. The supply situation tells you why it's about to become unobtainable. And this is where it gets terrifying. You need to understand the geography of scarcity. Gold is mined on every continent. Silver is mined everywhere. Platinum? Roughly 75% of the world's primary supply comes from one single country, South Africa. And South Africa is teetering on the edge of becoming a failed state. Their infrastructure is collapsing. Their state utility, Eskom, is broken. They have load shedding, planned rolling blackouts, sometimes for 10 or 12 hours a day, because they cannot generate enough electricity to run the country. Here's what most people don't realize about platinum mining. It is brutally energy intensive. These are some of the deepest mines on Earth. You cannot run them without consistent, massive amounts of electricity. You need power to run the lifts to get men down and ore up. More importantly, you need power to run giant refrigeration plants to keep the air breathable half a mile underground. When the power dies, the mine stops. Period. It gets worse. Due to inflation and energy costs, the all-in sustaining cost to pull an ounce of platinum out of the ground in many South African mines is now higher than the current market price. This is Econ 101. If it costs you $1,100 to create something you can only sell for $950, you stop creating it. Miners are high grading, taking only the best ore and closing less profitable shafts. Supply isn't just flat, it's actively contracting. What about Russia, you ask? They are the second largest producer. Well, they are currently the most sanctioned country on Earth. Relying on Russian supply to bail out the West is not a strategy, it's a delusion. We are facing a structural, multi-year deficit that cannot be fixed with a switch. You can't just build a new platinum mine overnight. It takes a decade. The supply cliff is real, and we just drove off the edge. Now, I know the bear case. I hear it in the comments section every time I mention platinum. Alex, platinum is just for catalytic converters in gas cars. The world is going EV. Demand is going to zero. This is the single biggest, most expensive mistake investors are making right now. Yes, battery EVs don't use platinum, but the green energy transition is much bigger and much more complex than just passenger cars. Batteries are heavy. They take too long to charge. They are terrible for heavy transport. You cannot run a container ship across the Pacific on lithium-ion batteries. You can't run long-haul trucking fleets that need 24/7 uptime on 4-hour charging cycles. So what's the solution for heavy industry decarbonization? Hydrogen fuel cells. And guess what the essential, non-negotiable material is inside a hydrogen fuel cell to make the chemistry work? You guessed it, platinum. It is the only metal that can efficiently split the hydrogen molecule and create electricity without burning it. We are talking about a source of demand that is currently a rounding error, that needs to scale exponentially in the next 5 to 10 years to meet global climate mandates set by the EU and China. It's not just using the hydrogen, it's making it too. The electrolyzers needed to create green hydrogen from water require massive amounts of platinum group metals. The market is pricing platinum like it's a dying fossil fuel relic, like Blockbuster Video in 2010. In reality, it's a critical green energy metal, the lithium of the hydrogen economy. The demand pivot is happening right now, and the market hasn't priced in a single cent of it. Okay, the thesis is terrifyingly good. Supply crash, demand explosion, historical undervaluation. So how do you play it? Because it's not as simple as buying gold. Option 1, physical bullion. I love holding the real thing, but be warned, the premiums over spot price on platinum coins are brutal compared to gold. And when you go to sell, Your local coin shop might not want it. It's harder to move than gold or silver. Option 2. ETFs. Look for physically backed trusts like PPLT or Sprott's SPPP. These are the easiest way to get exposure in a brokerage account. It's liquid, the fees are okay, but you have to trust that the metal is actually in the vault. In a true crisis, paper promises can evaporate. Option 3. The miners. This is for the cowboys. These stocks are leveraged bets on the metal price. If platinum goes up 20%, the miners might go up 60%. But remember where they are located: South Africa. You are taking on massive political, labor, and energy grid risk. This is not a set it and forget it trade. So let's bring this back to you, the gold and silver investor. I'm not telling you to sell your gold. Keep your insurance. But understand that the gold trade is the most crowded lifeboat in the ocean right now. Everyone knows the thesis. When a trade is this crowded, the easy money has already been made. The warning here is about opportunity cost. While you are high-fiving your buddies over gold inching up 10% in a year, you might be missing the asset that is coiled to correct a 20-year undervaluation while facing the worst supply crisis I've ever seen in commodities. Gold is emotional insurance. It makes you feel good. Platinum is cold, hard, uncomfortable industrial reality. And right now, reality is screaming that the price is wrong. Uncomfortable math always wins in the end. Don't let comfort cost you wealth. If this video opened your eyes to what the herd is ignoring, hit that like button and subscribe so the algorithm knows you prefer data over dogma. I'm Alex. Stop following the crowd.